Hello and welcome to this edition of Property Focus. As always, happy for you to join us. Today we are going to be talking about the real estate market cycle. And in talking about the cycle, we'll be discussing the four stages of the real estate market cycle. Okay, I thought we should do this today to gain an understanding of what happens in the real estate market, which information I thought would be important for would-be investors to have an understanding of as they make their investment decisions. Okay, so what goes on in the real estate market as you look to invest, and when and where do you want to put your investment, and when do you want to get the best returns for that investment? Right, so the real estate market cycle. Now, the real estate market cycle lasts between 10 and 18 years. This is particularly pronounced and observable in the developed world, but also applicable elsewhere across the globe. Okay, and this market cycle has four stages, which stages are the recovery stage, the expansion stage, the hypersupply stage, and the recession. So you have the recovery stage, you have the expansion stage, and you have the hypersupply stage, and then you have the recession. This video we will try and dig into each one of those stages in more detail, right? So we begin with the recovery stage. The recovery stage is when you have the market at its worst but starting to recover. Okay, the recovery stage is when you have the real estate market at its worst but starting to recover. At this stage of the market, property prices are way below market value. Okay, it's also the longest of the four stages of the cycle. So at this stage, property prices are way below market value. This is when you want to swoop in and buy properties at rock bottom prices. You can then hold those properties, you can add value to them, you can renovate if you want to renovate them, and hold to sell at a later stage of the cycle for super profits. Okay, so that is the recovery stage of the market. And then the second stage of the market cycle would be the expansion stage. So during the expansion stage, you have an increased demand for property. Okay, this is particularly true for the housing segment of the market, but also applicable to the other segments as well. So you have the commercial and industrial asset classes also seeing an increased demand during the expansion stage. The expansion stage is when property developers want to develop their properties. Expansion stage is when property developers want to develop their properties. It is also the stage when you want to pay particular attention to market trends, right? For reasons that will show themselves as we discuss the other two stages of the market cycle, right? So that is the expansion stage. After the expansion stage comes the hypersupply stage. The hypersupply stage, as the term suggests, is when you have more properties than you have investors or buyers, right? So the hypersupply stage is when you have more properties than you have investors or buyers. We saw this happen during the COVID pandemic, okay? And this is when you've had too much property development and now you have more property chasing investors or buyers. What do you do during this stage of the market cycle? Okay, you want to hold on to those properties because now you're beginning to have a fairly accurate understanding of what is happening in the market, right? You know that after the hypersupply stage will come the fourth and final stage of the market cycle, which is the recession. Okay, the fourth and final stage of the market cycle is the recession. The recession is the end of the current market high, okay, where you have the supply overwhelming demand. And in this stage, usually you have your rent being lowered, to attract customers. People are struggling to get customers to occupy their properties. So you have them adjust their rentals downwards to attract clients, and so on and so forth. You also don't know that you are in a recession until way after it has set in. It's an interesting thing about recessions, right? You know you are in a recession way after you've entered the recession, right? which is the fourth and final stage of the real estate market cycle. Okay, so those are the four stages of the real estate market cycle. Now, what factors influence this cycle? What are some of the factors that influence the cycle? The first, there's quite a number of them, but just to mention a few, the first one would be global crisis. Okay, so I mentioned earlier the COVID pandemic. We saw what happened in the real estate market during the COVID pandemic. In particular, the commercial segment. We saw office occupation plummet, sometimes to as low as a third, of occupancy, right? Because all of a sudden people had to work from home, and so there wasn't as much demand for office space, right? So that's what happened during the COVID pandemic. Interestingly, in certain markets like the United States, you saw people begin to dispose of properties at rock bottom prices in the commercial real estate market, right? So you had investors sometimes selling a $400 million property, sometimes for as low as $200 million, or even $150 million, as we're scrambling to meet obligations with the banks, lenders, and so on and so forth. So that's one of them. The other would be, natural disasters, typhoons, and so on and so forth, that devastate the property market, resulting in significant changes in the market. Okay, these also often disrupt global supply chains, which also impact the market cycle or speak to the four stages of the cycle itself. Okay, the next one would be population disparities. You have gaps between demographics, right? So if you have a significantly young population in a given market, that will begin to show in the movement of the real estate market. If you have young people who don't have the liquidity to purchase a property, or even the need for it, then you begin to see a market that shows that, right? Conversely, if you have a significantly older population, for the majority in a given market, you have people, say, typically between the age of 50 and 65, in the majority in a given market, you have a customer base with the liquidity, the means to purchase properties, or even the need for them, right? You have people investing in commercial real estate, office space, and so on and so forth. They're investing in industrial real estate, your warehousing, your depots, and what have you. They're also investing in residential real estate, for somewhere to live, right? And that shows in the market. Your interest rates are another one. If you have too high interest rates, it discourages people from acquiring mortgages to purchase property. It discourages commercial real estate developers from going to banks to acquire huge loans to make these developments, these large-scale property developments, right? Which then also begin to show in the market, which also then impacts the cycle itself, right? So those are just a few of the factors that impact the real estate market cycle, which are important to be aware of as a would-be real estate investor. Right. So that wraps up this edition of Property Focus. As always, happy for you to join, and we will see you on the next episode.